Welcome to Know More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, everyone, and welcome back to the CreditSights Know More, Risk Better podcast. This is Winnie Cisar, Global Head of Strategy at CreditSights. And today I have two special guests joining me to talk about the world of private credit and BDCs. We have Andrew Hedlund, a managing editor at LFI, a CreditSights sister company, and Zach Griffiths, of course, you all know him, love him, our head of U.S. investment grade and macro strategy. Thank you guys for joining me today to talk about something that seems like it's making headlines by the minute, by the hour at the very least lately.
Thanks for having us, Winnie. Yeah.
All right. So I think that most frequently what we've seen is headlines around either redemption requests or private credit funds having to mark down assets that, they were at par last week and now they're a donuts. A lot of people, of course, are asking, are we witnessing a true turning point in private credit? Is this kind of the inflection point, or is it just a healthy correction? And Andrew, in a recent report, you wrote, facing scrutiny from the First Brands and tricolor fallout, headlines of cockroaches and now market jitters around AI and software, the golden age of private credit is indeed past. So let's turn back the clock and set some context. What made the golden age so golden? And now are we a golden goose? Fool's gold?
Well, to start, if we go back to the 2021 deal boom, that was obviously fertile ground for deal making. So many transactions were done. And there remains a lot of those structures in place. We can get to that in a bit, but that's more a result of higher leverage levels. Just specifically focusing on that golden era, though, what made it so golden was particularly in 2022 and 2023. Ukraine war and regional bank crisis made private credit funds perhaps the most viable funding source. There was a lot of names that were in the syndicated market that were B3 or B- transitioned to the private credit market because it was a tougher time to get deals done that were perhaps viewed slightly risky. Then there was obviously the retail capital inflow. You mentioned redemption headlines, Winnie. That's in the same sphere of this. There were these perpetual BDCs that can continuously raise capital, and a lot of that capital is coming from retail investors, and most of them have a redemption feature in which they can repurchase up to a set amount of shares each quarter, and it's generally 5%. So the golden age, though, what made it really, really nice was that the lenders were able to get fairly attractive credit spreads. We're talking in some cases north of 600, but it really that really has retreated. One fund manager I remember saying to me at the time that he could invest in performing first lien paper for his opportunistic fund, which had a return mandate of mid-teens. So just to give you an idea, it was lesser risk for larger returns.
Yeah, especially when we think about the context of the markets were a bit volatile in 22 and 23, but the broader economy was outperforming. And so it really was this kind of best of both worlds for these private credit funds that were realizing these outsized returns while also having the support of generally stable fundamentals. clearly a lot of that has shifted as of late. And Zach, I think that what strikes me is the market is really trying to understand if the cracks in private credit are just cracks or are they fault lines? Is this some sort of true systemic breakdown that we are starting to see? Can you walk us through some of these recent events and why is exactly the market so worried? Credit losses happen every day for lenders.
Yeah, I think that's an important point, Winnie. I mean, credit losses are part of the business of extending credit, typically by banks, but certainly private credit lenders as well. We've had plenty of fallout from some big names like First Brands and Tricolor last year. Both of those appear to be due to fraud. Tricolor, for example, pledged the same collateral for multiple loans, and then the opaque financing structure in First Brands, this factoring some off-balance sheet items that were poorly understood, perhaps by the broader market, interesting by the lenders as well, seemingly. And so I think to say that fraud is prevalent across the market seems like an incorrect takeaway from all of this. It is interesting to consider the off-balance sheet financing aspect of it, as that sort of creeps into even the investment grade private credit market. And I don't think we don't necessarily view it as cause for concern right now, but it's interesting to think of the incentives behind moving some of this off balance sheet and how that fits into some of these large issuers' management of risk. But overall, I think the way we're framing this right now is that it's more of perhaps a reset in terms of what you can expect from private credit returns relative to high yield bonds and broadly syndicated loans. I think historically you've earned a premium even after adjusting for leverage, and that's already shifted a bit over the past couple of years. And I think that could remain in a different environment where you aren't getting that boost to returns from private credit and perhaps are accepting greater risk. I like the environment Andrew mentioned where you have less risk and greater return. I think that's definitely flipped on its head more recently.
Yeah, and just correct me if I'm wrong, either of you. First Brands and Tricolor were not private credit deals. Those were actually both in the broadly syndicated loan market, right?
That is correct. So the idea that private credit firms are getting scrutiny from the First Brands and Tricolor fallout, they will say these aren't the types of loans we make, and that's generally true. There were some BDCs that did hold that paper, though. So to say they were completely not exposed isn't quite accurate, but it is accurate to say that was generally not the type of loans that direct lenders are making.
Yeah, and I think that the First Brands and Tricolor headlines were so worrisome to people because it's kind of a hallmark of when any asset class is attracting capital with the magnitude that private credit and the broadly syndicated loan space have for the past decade, then oftentimes there are problems in the underwriting standards and the monitoring, and you do see these things start to pop up. And sometimes it's just that kind of law of large numbers. Like for every dollar that is lent, 99 cents might be okay, but there's 1 cent of more bad actor there. And I think that a lot of people right now are trying to figure out, where is that next problem sector? I'd like to note First Brands and Tricolor are both not software companies, and yet we are now all of a sudden very worried about software as AI and the implications for software. I actually just saw a headline from Bloomberg right before we hopped on that software public equities are selling off because Amazon announced that they're working on AI-enabled software development for some programs, which, tough to compete with Amazon for sure. So Zach, I think setting some context around the software sector and technology as a whole, has that sector been a key driver of defaults in private or public markets recently? I think we all know about the dot-com boom, but how about in recent years?
Not really, Winnie. I mean, and so we have a good lens into this through our colleagues at Fitch Ratings. They have a overall private credit default rate a privately monitored ratings portfolio for deals that they rate for private deals that they rate for insurance companies for regulatory reasons, and they have a model-based credit opinion. And they break down all of these default rates by various subsectors. And so just to set the stage, the highest is the privately monitored ratings portfolio that has a default rate of 9.2%. That's as of 2025. A lot more is included in that relative to kind of what we see in the broadly syndicated loan and high yield bond market. And so that compares to 5.6% for private credit overall and 4.5% for the model-based credit opinions portfolio. Now, within all of those, there is a technology software bucket. And so for private credit, has a 9.2% overall default rate. Tech software is just 2.5% of that. For the privately monitored ratings portfolio, which has the highest default rate, that has 0 from a tech software perspective. And then for the model-based credit opinions portfolio, that has the overall 4.5% that I mentioned, only 3.1% of a trailing 12-month default rate for tech software. So that's really not the driving force behind these default rates that have come up a bit, but I don't think are terribly concerning. Some of the sectors that are seeing greater challenges from that default rate perspective are cable, tech hardware, interestingly, and broadcasting and media. And there's some pretty big discrepancies between these portfolios. So none of them are perfect, but I think having access to all of them for us to consider is very helpful. But zooming out and thinking about this software issue and whether it is a symptom or representative of a symptom of the broader market, I think A, the answer is no, and B, it's really not a fundamentally driven concern. I think there's definitely reason to wonder what kind of ability to push price these software companies will have going forward. I think historically it's been very strong. And then what is the terminal value of these companies in 3 to 5 years? And it's probably not the only subsector for which we'll see that reconsideration as a result of AI. It's just the first one since AI was written by software developers. So AI kind of knows how to do that job first. And I think there's an ongoing effort to broaden out that ability by AI. So that's a long answer for no. The fundamental, anything happening on the fundamental side is not really driven by software right now, but I do think that you're seeing more of that disruption activity of AI having an impact on the private credit market, perhaps outsized because of the exposure to that sector, which is kind of a big shift from, I think, what has been an extremely optimistic outlook for markets and the economy driven by AI up to, let's say, the start of this year.
Oh, go ahead, Andrew.
One of the things that's important to note is, as Zach pointed out, it's nothing fundamental. A lot of these companies are doing well financially. The questions are just around future growth. And so if I'm an investor, how do I answer questions from investors about my LPs about, what does this software mean for you going forward? It's hard to say, we know for sure, because anybody that does is probably not telling you the truth, but all the lenders I've talked to, they just say, yeah, this is something that we have to figure out. We are in a good financial position, and that's the best we can do, right? We don't know how to read the future. We can go into whatever the next challenging time is with a solid balance sheet, on both the fund level and the corporate borrower level. So that's just a little bit of the tension that's going on right now in the private credit market.
Yeah, that's a super helpful addition. And as I was thinking about both of your comments, oftentimes there are sectors where the perception of fundamentals gets a bit skewed. And then the reality of technicals is what does them in. Because if investors are concerned about a sector, about an issuer, then borrowing costs are going to be super high. And that effectively means that refinancing is off the table. Any sort of potential exit through M&A is off the table. And then it does become more of that stressed story. And so it's almost kind of like a run on the bank type situation where it may be that fundamentals are okay, but the perception and the kind of rumor mill starts to get going, and then all of a sudden liquidity dries up for a whole host of issuers or a sector. And we know that, there's an awful lot of software loans out there within private credit, within the broadly syndicated loan space. So you have, a relatively significant refinancing need, not near term, it's not a 26, 27 event, but once you start to get into 2028 and 2030, it definitely grows. So, Andrew, another thing that is kind of reminding me of the run on the bank type situation is the media narrative around BDCs. It used to be in the golden age of private credits that BDCs were democratizing alts. They were opening these investments that usually only institutional investors or people with connections have access to. And now it's a lot more sinister. So how did that happen? How do we go from we should be opening alts into 401k access and BDCs are the best things ever to they're going to take down the financial system?
So it is, as you noted, quite a swing. The answer in reality, honestly, is probably somewhere in between. I think that the biggest question around these funds is, do they belong in an individual's portfolio? And I don't mean in individuals and retail investors writ large. I just mean, the specific person. And so you've seen redemption requests around these funds because I think part of it is driven by the headlines and the sentiment. People that are retail investors generally experience the financial markets more through headlines than necessarily fundamental analysis. But also, one of the things to think about is that these BDCs, the retail investor portion is a small investor constituency of the asset class writ large. So that's one thing to keep in mind. But obviously, these redemptions are something that managers have to deal with. Thankfully, I'm not running a BDC fund and have to make these calls. But obviously, you've also seen the publicly traded BDCs trade off, at a significant discount.
Yeah, Zach and I were just checking out one of the BDC ETFs, and it's down about 30% in recent months. And Andrew, your point around, BDC retail investors being a relatively small share, I think is really important because as private credit became kind of the booming asset class, people were very focused on who is exposed to it. And the Fed Office of Financial Research actually just put out a really great report looking at investors within the private credit space. And pension funds account for about 30% of the private credit universe as defined by the Fed, which was very focused on that core middle market lending universe. Quite interestingly, individuals were about less than 10%, call it 9% share, so significantly lower. Insurance companies are at about 11 to 12%. I know a lot of people are very focused on insurance exposure to private credit right now. That's something that our insurance analyst, Josh Esterov, has been very focused on because private assets on insurance balance sheets have absolutely been increasing over the past, call it decade. But a lot of the private assets within insurance are not direct lending middle market. There's a good chunk of it, and that has grown. But there's a lot of other stuff in there as well that is a little bit more investment grade related. Banks, interestingly enough, are maybe 2% of private credit net assets by investor type, so relatively low exposure. Of course, there are other ways that banks have exposure to non-bank financials, mostly the lending relationships between banks and these private credit funds or BDCs or other intermediaries in general. And then another thing that I oftentimes ponder when I'm trying to fall asleep at 3 a.m. is the linkages between the public leverage finance markets and the private credit markets. And I think similarly, we can say this is true as well about the investment grade public versus private market. Historically, in recent years, private credit has really served as a very valuable source of liquidity to the public markets in 22 and 23. As Andrew noted, there was a lot of public market volatility. Private credit stepped up, underwrote some deals that couldn't get done in the public markets. And that was really beneficial in keeping default rates low, in ensuring that liquidity continued to flow. So if we see this slowdown or kind of a freeze in direct lending, what does that mean for high yield and broadly syndicated loan spreads? Does that mean that we have less of that kind of natural liquidity offset to help support things. And it means that, defaults could be ultimately higher in the public markets. We haven't necessarily seen that yet, but it's something to consider. And then also, as we think about the amount of issuance or funding needs for AI infrastructure build out from the hyperscalers, from data centers, a lot of that is going to the investment grade market. And I think there is kind of this private market backstop. We saw Meta and Blue Owl do a JV last October, I believe it was, for some data center build out in the IG private market space. If that starts to dry up a little bit, what does that mean for investment grade bond spreads? So Zach, I guess I'd like to follow up there. Why should IG investors care about what's happening in BDCs and private credit? Like, does this matter to them? Is there bank exposure? Is there BDC exposure? What should we be considering?
Yeah, I think you sort of hit on it a little bit already, Winnie, but looking at the banks, looking at loans to non-depository financial institutions, and that's even broken out further. Business credit intermediaries is probably the closest thing to private credit specifically, but private credit can mean a lot of things. And so, I mean, thinking about the banks, well, less than 13% of their overall loan books are to non-depository financial institutions. That's up from just 5% a decade ago. So it's risen, but by no means a huge part of it. And so we don't see it as a major risk to the banks. In fact, we still have an outperform on US financials. I think balance sheets are very strong there, and there are some regulatory tailwinds at their backs right now. So I think it's something to watch. I think your point about, let's say we get into an environment that all of a sudden feels a little bit like 22 and 23, maybe the Fed and other major central banks have to hike as a result of the inflationary pressures from what we're seeing with the war in Iran. And even since we started recording this, I see that we are sending troops to the Middle East, airborne troops, not boots on the ground, boots in the air. I'm not a military strategist. I don't know how that all works, but I think that's throwing a major wrench into sort of the outlook for capital markets, the outlook for policy. And so the idea that the private credit market won't be there this time around to supply that liquidity, I think is a major concern, is probably more of a direct concern for the public markets on the high yield side, like high yield bonds and leveraged loans. But I think if you start to see that creep in, I don't think U.S. investment grade spreads will be completely immune. To your point on the insurance side, definitely seen exposure to private credit grow substantially to around 31.4% of the insurance investment portfolios. That's up from 22% about a decade ago. So again, not crazy, definitely a huge portion. And from our perspective, it's something that we're monitoring, but we're not expecting, let's say, in the next 12 months, private credit to be the driver of major regulated financial system stress. It could be that it causes some consternation for investors, but we don't think it's going to topple the financial system or look anything like prior major financial crises. And so some interesting dynamics to keep an eye on, but not something that's keeping us up at night from a regulated financial system perspective.
A lot of other things to keep us up at night. And, traditionally in times of war, you go airborne first to kind of scout things out so that boots on the ground can follow. At least that's how the Iraq invasion of Baghdad worked in 2003, because my husband was up in the air scouting it all out for the Army Corps of Engineers to get into the city, which is a wild thing to contemplate. All right, so Andrew, private credit deal flow. Does it still exist? Are deals getting done? Is there cash being put to work? Is there demand for cash to be put to work? We know there certainly was last year.
So I was talking to a lender earlier today, and he said they were very optimistic going in to the year, but now we kind of find ourselves in a similar situation before where we came in hopes pretty high, and now it's, hopes aren't too high. Software deals are definitely done in terms of they're on ice. There's no real new ones coming around. You have some deals that are getting done. Those are generally away from the software area. And then the other thing to think about is what's the ultimate end sector? There are specific subsectors in, say chemical or in say industrials or healthcare, right? Just these like large picture sectors. Some of them are a little better than others when it comes to, AI risk. And so the biggest thing to think about is what are the types of companies and, what are the valuations? Because I believe that valuations have come in somewhat, obviously borrower specific and sector specific too, but it's certainly a lot less than lenders and sponsors would have wanted.
Yeah, so Andrew, I'm gonna stay with you, and I have this kind of thing stuck in my head where it seems like direct lending has effectively been a victim of its own success, right? Like it raised a ton of cash, which meant there was a lot of competition for deals, which meant that pricing tightened up a ton. And so when you think about that for forward returns, feels like they're ultimately going to be lower. Do you have kind of a similar assessment where the ability of direct lending to raise so much cash is eventually kind of leading to its own problems? And what should like a realistic return expectation be for the asset class?
Sure. So just to start with the question, has it been a victim of its own success? And the answer is kind of. There have been concerns that have popped up about leverage at some of these portfolio companies. The question there emerges if they have to spend a bunch of their cash on meeting their obligations. How much does that leave to invest in new products as AI comes around, or to enhance the current products that you have? Obviously, if cash flow is limited because of higher leverage, borrowers will have a harder time adapting. And in terms of what the low spreads mean, it's kind of a double-edged sword for managers. It lowers the return and the yield is less, but at the same time, it's good news bears for the borrowers because their interest costs are less. In terms of what a realistic return expectation would be, likely high single digits. Obviously, the question emerges what happens to these returns if there's meaningful credit losses. And just to clarify, that's on an unlevered basis. So if there's leverage in the picture, it gets higher, sometimes low teens.
Mhm. I mean, low teens sounds like a dream at this point for sure.
I
I
mean,
think
no,
that oh
I was just saying, note that that's levered. So
yeah,
that's an
uh-huh. Oh,
important
that's true.
distinction.
Yes, that's very true. The levered returns being in the low teens. So I also want to note, on the covenant side of things, and actually the team at Covenant Review put out a great report today looking at some of the covenant specifics of the software space within the loan market. And it's really important that covenants within private credit in general are still better than within the broadly syndicated loan space. There are some caveats there, of course, in that some of the software loans within private credit are a bit weaker than the comp set of cohort because a lot of those issuers were viewed as kind of rock solid. They had all of the hallmarks of what private equity and private credit sponsors wanted to do. That was recurring revenue, asset light structures, and now there's been a pretty significant rewriting of all of that. So definitely check out the Covenant Review article because so much of ultimate recoveries is going to depend on what sponsors can do to these companies in terms of transferring asset value, in and out of investor hands. And the difference between a par recovery and a very low recovery will oftentimes hinge on those covenant dynamics. So Andrew, if we are entering this kind of lower return, potentially higher default environment, maybe lower recoveries, what are you thinking about for future demand for private credit and BDCs? Like, is capital still being raised right now? When will capital raises come back?
I wish I could tell you with certainty that I know, but I honestly don't. The idea that these redemptions are front and center is real. So the question currently is mainly among retail investors. As I mentioned, it's not a large part of the investor base currently, but particularly as you mentioned, with the push to get private credit into 401ks, there has been a view among asset managers that the retail market is a strong growth prospect. So, that sort of comes into question, perhaps. And then on the institution side, it'll take more time to tell. Over the past 15 years, many LPs have rejiggered their portfolios to include a specific allocation to private credit. So just to remain within that framework, they'll need to allocate to their portfolio. But the really important thing to watch on the institution side will be what do they do with their portfolio in the next few years? Do they decrease that exposure? What are the movements there? And obviously, credit performance is obviously important. If the LPs aren't getting the returns they were expecting, that's going to be, it'll be a hard case to keep them in the asset class to the extent that they have been.
Absolutely. So I think that we can wrap up the conversation with maybe some things that we're watching and trying to assess, if this is going to escalate, what are some of the early signs? I think the headlines around redemptions are definitely, if not an early sign, a maybe more kind of middle inning type sign. But Zach, I'd be curious to hear from your perspective as a macro and investment grade oriented person who's all of a sudden become an expert on private credit and BDCs. What are you watching to know where kind of the next round of fallout is going to be, or if this is going to become a bit more systemic?
For me, Winnie, I'm considering if we start to see funky market moves elsewhere to suggest that there really is some liquidity challenges, concerns about performance in other parts of large institutional portfolios. The challenge is with everything going on geopolitically, it's probably going to be that much more difficult to discern where you're seeing, let's say, even a sell-off in treasuries, which has been very common over the past several weeks. What portion of that is due to just a marking up of expectations of inflation in the Fed relative to forced selling to raise cash that can't be generated elsewhere? So I think that'll be interesting to watch just to see how disorderly things get. It's certainly overly complicated by everything else going on in the world, but that's where my head goes in terms of ways to discern this becoming a broader markets issue.
Yeah, I think that that is a great point for sure, and something that we kind of interestingly saw during the early onset of the COVID volatility, where a lot of higher quality corporates things started to get a little bit loosey-goosey as investors were trying to raise cash, go into the 10-year treasury at 50 basis points. Those were the days. All right, Andrew, how about you? What are you looking at to kind of stay on top of where all of this goes next?
So, first, I'm looking at the back leverage because there's been a growth in the amount of bank facilities that have been provided or the amount of commitments. You mentioned that report from the Office of Financial Research earlier, Winnie, and I believe it was they pegged that 410 billion to 540 billion had been lent to private credit funds by banks. So it's not nothing. That is something that I think will be important because there's probably much more systemic risk. I'm not saying, it's going to fall apart. Just the retail remains, like I said, a relatively small part. But if all of a sudden you have firms that have lent to these private credit funds marking down those assets or other worrying developments, that's something to keep your eye on. And then just one of the other things that that's worth highlighting, there's been a lot of comparisons to 2008. I feel like those are a little premature. What made the GFC so unique to a degree was that they involved mortgages. Everybody has not everybody, but a lot of people have a mortgage. It's, where they live. It's their primary source of wealth. So, assuming we're just looking at this in private credit in, a vacuum, that's not the case. I think a lot of the people that are retail investors are probably more well-off individuals. So if you put it in the larger macro picture, there could, of course, be some issues that arise in private credit as a result of other things. But I don't think you're at 2008 conditions yet.
Man, I really hope we're a little more than a little premature on the 2008 comparison, because that was wild. And for me, it just comes down to the banks, the back, even if all this private credit goes seemingly as poorly as it could, I think the banks are so well capitalized that the tail risk of something like the financial crisis has to be taken off the table. But maybe people were saying that in 2008 too. I don't know.
I guess, the reality of private credit has emerged because of fallout from 2008, where the banks were more highly regulated and the economics of middle market loans no longer made sense in this new regulatory paradigm. So, if there is impact where the non-bank financial intermediaries no longer are able to provide capital to small and medium-sized enterprises, and private equity loses its source of funding. I don't want to say systemic, I don't want to be Chicken Little here, but maybe not a GFC type event, but kind of bad.
Basically, the only place a 2008 level thing can happen now is in private credit, I guess, because we pushed all that risk there outside of the banks.
I think the other thing that's important to note too is a lot of these people are talking their book. If you ask direct lenders, private credit is the best thing ever. It's the silver bullet. It'll cure cancer. But if you ask the people that are shorting the BDC stocks, it's the worst thing ever, and it's gonna bring down the entire world, right? So you also have to think about the motivations that a person has as they're talking about these things. I try to be relatively independent. I don't, have any skin in the game in terms of investing in any private credit funds, obviously. So I try to, take a reality-driven approach and keep things grounded in facts as opposed to, getting caught up in the narrative of it all.
I mean, the reality is facts don't really sell on social media. So we see the two extreme sides, and that's how we make a market. And there is clearly some market being made in the world of BDCs and private credit right now. All right, Andrew, Zach, thank you so much for joining me today to walk through the world of BDCs and private credit and all of the moving pieces. If you are interested in learning more about any of the topics that we discussed, you can always reach out to your CreditSights sales representative or to me, Andrew, or Zach directly using that lovely Ask an Analyst feature on the CreditSights website. All right, thanks for joining, thanks for listening, and we'll talk to you again soon.
Thanks, Winnie.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.